Well, those are some beautiful images of the world ushering in the new year and the new decade. Hi, everyone. A very good evening and wishing all of the viewers of The Money Show and ET Now a very happy and a prosperous 2020. I'm Mubina Kapasi and we're continuing with our New Year programming. So here's what we have lined up for you today on The Money Show. We are going to be talking about some of the decade's best performing mutual funds, and among them is Canara Robeco's emerging equities. So the fund manager and the head, Nimesh Chandan, will be speaking with us on the strategy and what should investors watch out for in the decade to come. Also, if you believe that you need financial knowledge to actually make money in the markets, think again. Here's a marketing consultant that actually managed to create long-term wealth using mutual funds, and she started off just when she got her job back in 2007. It's 2019 and now she's been able to make a good chunk of money with the help of a financial advisor and, of course, the wise allocation of money across various mutual funds. But what will 2020 look like then? We had none other than Nicholas Taleb's big prediction for 2020, and for the year to come, I know one trend that will never fade away, and that's travel. Thomas Cook shares with us the top travel trends that will rule in 2020. And apart from travel, I don't think any of us are going to let go of our gadgets as well, with our cell phones literally becoming the sixth finger. We will be getting you a glimpse of the gadgets to watch out for in the decade to come. But before we start any of that, let me first talk about the big mutual fund performers of the last decade. Yesterday, we ran you through a whole host of them. It was interesting to know that thematic funds were really the key outperformers, with an FMCG fund, an MNC fund as well, even Aditya Birla. Many of you guys who have Aditya Birla funds in your portfolio may right now be complaining about how it's not been performing. But you know what? Even that one was an outperformer in the last 10 years, which just goes to say that the longer you hold your funds, the better it is for wealth creation. So one such outperformer is the Canara Robeco Emerging Equities Fund. Let's tell you a bit about the fund. In the last decade, it has managed to bring about 450% of returns, which means that if you had started an SIP of 1,000 rupees, let's say in Jan 2010, the corpus today would be worth 3.12 lakh rupees. And I'm sure many of you would like to make such returns. And another thing to watch out for is that if you had done a lump sum of 1.2 lakh rupees of an investment, let's say if you didn't do an SIP, you just straight away put 1.2 lakh rupees as a lump sum figure 10 years ago, today you would be sitting on a corpus of almost 7 lakh rupees. Now, who wouldn't love this kind of wealth creation? As you know, mutual funds, it is suitable for capital appreciation in the long haul, and hence if you look at the returns as well, since inception the CAGR is the best, coming in at a good 14.3%. The 1 year CAGR, thanks to the problems with respect to the markets, has been a bit weakish. Here are some of the top holdings, and unsurprisingly, it's the financial space names that have really dominated the AUM contribution. So HDFC Bank, almost 7% of the AUM invested there, followed by ICICI Bank, HDFC Limited, Kotak Bank as well is something that's among the top holdings. City Union Bank, again from the small cap space. And then you have other names like Reliance Industries, Infosys, Atul Limited, as well as an Aditya Birla Fashion Retail. Those are some of the stocks that are held by the Canara Robeco Emerging Equities. Well, on that note now, let's bring on board the fund manager and the head of equities for Canara Robeco, Nimesh Chandan. He of course, is the head of the AMC. Nimesh, thank you so much for joining us. You know, your fund has been among the best performers of the decade gone by. So share with us, what was the secret sauce?
Well, the secret sauce, I would say, is a good investment process and a good team of investment professionals. As managers, we don't directly control our investment outcomes. We control them indirectly through the ingredients that we put into our investment selection. And the two main ingredients are a good investment process and a good team of professionals that help identify these opportunities. In Canara Robeco, we have an investment process which works on the attributes of fundamental analysis, Plus, we have populated this investment process with tools from behavioral finance to improve our decision making. And as far as people are concerned, we've been able to attract a good team of analysts and fund managers over the years. These are people who are very qualified in terms of the diverse skills of investments that they possess. Plus, they have common values that we look for. As a theme, our funds are run on a quality bias, so the companies that we pick up are good quality companies within each sector. And because markets tend to be quite volatile, not only our stock selection but also our risk management in terms of managing our exposures to sectors, stocks, and liquidity of certain companies. We manage those well, and that gives us over a cycle much better returns.
Okay, so Nimesh, give our viewers a sense of wealth creation. If let's say a person had done an SIP of 1,000 rupees in the Canara Robeco Emerging Equities Fund starting in Jan 2010, what sort of corpus would he or she be sitting on right now?
So for every 1,000 rupee SIP done over 10 years for emerging equities, right now the corpus would be a little north of 3,12,000 rupees. If the same was put as lump sum, say 1,20,000 rupees put lump sum 10 years back, by now the corpus would have risen to a little over 7 lakhs. So it's been a compounding between 18 to 19% over the last 10 years.
Okay. Now, the name of the fund is the Canara Robeco Emerging Equities. So it's quite a tricky one. How do you pick and choose the so-called emerging equity stocks for your fund? What is that screening or the filtering process to ensure inclusion of only good quality businesses and managements? Because, the last 1 year we've seen as well that NAVs have come into problem because AAA rated companies have seen their businesses flounder.
So when selecting investments, we take a top-down as well as a bottom-up approach. In top-down, we try to identify trends globally as well as domestically and zero in on sectors and companies that benefit from those trends. On a bottom-up basis, we use our internal research, meeting with certain experts in the field to identify trends on a bottom-up basis. Also, we run screeners, which are based on either behavioral screeners or screeners run on fundamental attributes of companies that we want to have. Companies that come into our investment list or probable list go through a rigorous analysis of business management and valuation. As I said, we are more quality biased, so we prefer companies with very good corporate governance, good return on capital, companies that have scalability of growth, and to achieve that growth they have either a strong leadership in the industry or some strong brand franchise or a niche that gives them an opportunity to do better over the years. So these are the companies that come into our portfolio. Each of these companies is a company with a robust growth oriented business model run by a competent management and bought at a reasonable valuation.
Okay, Nimesh, moving on from that, I would like to talk about the fund composition. You spoke about how you choose your managements in the businesses. What about that split between large caps and mid caps? How is that? And I think I'm particularly interested in knowing about it since we had the SEBI recategorization norms as well.
So as a house, during the end of 2017, we had decided that we would reduce our holdings in mid caps and small caps. Here we were looking at very high valuation in this segment and we decided to reduce our exposure towards there. We certainly benefited from that in the last 2 years. In the recent past, so from H2 onwards of this financial year, we have turned positive on small and mid caps and we have increased our allocation in this category across our funds. Specifically for emerging equity, it would stand at about 50-50 as of November.
Okay. Now, keeping it with the constituents of your portfolio, I noticed that banking and financial and pharma form key chunks of your portfolio. So what is it that makes you so bullish in them?
So we have been positively biased as a house towards private banks and specifically retail banks for many years now. In the last 2 years, so specifically from March 2018, both on a fundamental analysis basis as well as some of the screeners we run, banks in the corporate side also started showing up as good potential investments. So we started looking at these banks and saw some important changes in trends. So we increased our exposure towards private corporate banks in the last 1.5 to 2 years. This has immensely benefited us as you have seen the performance of these banks. We also took opportunities in non-lending financials where insurance companies, AMCs, where we were able to see good growth, a good runway ahead for scalable growth ahead for them and available at a good valuations. So financials and BFSI has been more of a top-down approach for us. Pharma is a very bottom-up sector. This is a sector where you see huge divergence in company performance based on their product pipeline, their research pipeline, the markets that they are catering to, the therapeutics that they are catering to. If I were to fit a particular trend on our pharmaceutical picks, I would say companies in the domestic market, which are dominated by domestic revenues, and companies in the contract research and manufacturing services have generally done well for us and have been the areas where we have picked from.
Okay, so Nimesh, let's talk now about the risk factor, because that's what I think in this market where we have seen a lot of investors burn their finger, that's what I think is most important. So, and since it's the emerging equities fund, so it has a component of your mid caps as well. Would you say that the Canara Robeco Emerging Equities Fund would perhaps be a bit more riskier for investors, from an objective basis compared to, let's say, Canara Robeco's blue chip fund?
It entirely depends on how people identify or define risk. If you say risk is volatility, certainly mid caps and small caps have high volatility. So a company or a fund which has completely invested in large caps would be less volatile than mid caps and small cap fund. But I would say when you define risk as valuation risk or expectations risk, at this point of time I won't say that mid caps and small caps are more riskier than a large cap, because expectations from them are quite low. As a category, these have underperformed for the last 1.5 years. So I think that's where the risk is lesser at these levels. For investors also, I have seen historically risk tolerance goes up in terms of they want upward volatility rather than a downward volatility. So risk tolerance goes up when the markets are rallying and market or a category or a sector is at a high, and low when actually the sector has underperformed. Well, I would suggest that investors should look at doing the opposite of that. Ideally, they should be buying into pessimism and controlling their exposures during a euphoria. So I would say at this point of time, I don't see much risk in mid caps and small caps. So emerging equities, I wouldn't say as more riskier than blue chip in terms of returns. But yes, the volatility could be there going forward too.
Okay, so now that you've seen, a great decade for the fund, how do you see the next decade shape up for the Indian equity markets? Because, the India of 2019 is definitely very different from the India of 2010. So do you think it'll be difficult now to catch that next emerging trend or the next emerging stock to put in the Canara Robeco Emerging Equities Fund?
So over the past 10 years, there have been a lot of changes undergoing in the Indian economy, and we have benefited by identifying and forecasting these trends. Especially, as I said, during the last 2 years when the mid caps and small cap segment has not been doing well, the team has done a fantastic job in protecting investor wealth and identifying companies that have done well during this period. So our fund manager Nimesh Chandan has created a fantastic portfolio of companies that are long-term winners and have been able to withstand during this slowdown. Going forward, yes, in the next decade too, we will see continuation of some of these changes or continuation of some of these trends like financialization, digitization, investments in sustainability, financial inclusion, formalization of the economy. So in all these aspects, there are trends where certain companies or certain sectors benefit. We as a team focus on identifying these trends and picking up investments in these areas which will give the maximum return to the investors. For the overall market, we are quite bullish as we head into the 20s, the next decade. We believe as a house that in the next 3 to 5 years, you will see a good upturn in the business cycle. You will see an upturn in the economic cycle. The market rally will become more broad-based, and you will see good participation from mid and small cap companies in this rally too.
Okay, so yes, Nimesh, after completing a great decade, a lot of investors do tend to have this past return bias. So why don't you set that record straight? What return expectations should investors have now?
So it'll be difficult for me to exactly put in terms of numbers how the returns will be over the next decade. Obviously, the endeavor is to get the best returns for our investors. Typically, forecasting over a decade with even a small error leads to a big change in the number that you end up with. But we look to give better returns to our investors than the benchmarks and deliver a consistent and good performance for them over the next decade.
Okay, and finally, Nimesh, just to wrap up our conversation, what's your vision of what this fund can do for its investors, for its unit holders in the decade to come?
So we believe this is a fund where we are able to pick future winners. Even the large caps in this fund are companies which are growth oriented, which have huge headroom for growth going forward. So this is a growth biased fund with quality as its value. The same qualities continue for us that have delivered good returns for investors over the past decade. We'll continue the same in the coming decade, and that should give us good returns too.
Okay. Well, on that note, Nimesh, thanks so much for joining us, and we wish you all the very best. And I hope your fund is able to generate as much wealth, or perhaps more, in the decade to come as well as it did in the decade gone by.